Having looked at the financial statements, which is your balance sheet, profit and loss account, and the cash flow statement, we will now move on to a little more advanced way of looking at these statements by looking at how to interpret them. Now, there is information that you can just get by reading these financial statements, and at times there are kind of information that you might only be able to get by going deeper into those financial statements and analyzing them further for that information. Let's just first look at the objectives that we have in this session and then move on to see what kind of information we may not find just by looking at the statements. So what are this objective is essentially to use what are known as ratios as a tool to understand the financial statements much better, and the type of ratios that we will see are the profitability and return on capital ratios, the solvency or the long term viability ratio, the liquidity or the ability of the firm or the business to meet short term commitments, that kind of ratios, and also from a investment perspective, from a shareholder perspective, what sort of returns it is generating and how a shareholder might want to look at the firm or the company is what we will look at. So let's start one by one. First, let me give you a fair insight into why we need to look at a more deeper focus, or you want to look at there are questions that you may want to ask which are not answered just by looking at these statements. For example, if you were to ask questions of this nature as to how much profit is the company making per rupee of sales. Now, although you might have to do some sort of calculation, you might have to pick up the sales figure, then you might have to pick up the profit and relate the profit to the sales figure to understand how much per rupee of sales is the profit. Similarly, a question might come for every rupee of investment the shareholder is making, what is the return that is coming about. For that also you might need to understand the relationship between the profit and the investment that is made. You may also want to know if there is X amount of asset in the company, how much has come from shareholders funds and how much has come from funds outside liabilities such as loans and long term borrowings. Now those kind of questions also has to be answered. So we do some sort of a comparison between the various numbers that are available in the financial statements, and that technique that we use is also called as ratio analysis. It is essentially looking at the proportion or the ratio between numbers within the financial statements and arrive at some sort of an interpretation as to how we can look at these various aspects which otherwise are not available to us just by glancing or running through those statements. So as I mentioned here, that understanding what it conveys with regard to the financial position or performance is very important, and for that purpose we use what is called as the ratio analysis. And the broad categories of ratios we have already mentioned, as I stated in our objective. These are essentially in the nature of profitability, efficiency, solvency, liquidity, and from a shareholder perspective. But it is important also to understand that when you look at these ratios, just looking at 1 year will not help. You have to see the trend of the relationships over a period of time and see are they showing an improving trend or a deteriorating trend. And similarly, we need to not only look at one company but multiple companies of similar types to understand how those companies and the industry as a whole has been doing, to have a right context or basis on which our interpretation of the events that have happened can be made. So let's look at these ratios one by one. We look at what are known as the profitability and the return on capital ratios. As the name indicates, basically when you say profitability, we relate various levels of profit to the sales or revenue and understand how the behavior of those are. Similarly, from the efficiency perspective, we look at how assets of the companies are being utilized, how efficiently they are being utilized to generate the kind of profits that we are looking at. And the third is what is the rate of return that it is generating for the investors. So, these kind of questions will be answered by looking at what are known as profitability and return on capital ratios. So, broadly we will look at the overall performance analysis through what are known as profitability ratios first, and thereafter we will look at from the efficiency ratios angle also, and then see how the two combine together at a later stage. So, what comprises of profitability ratio? There are two types of ratios. One are known as profit margin ratios, which compare the various levels of profit to the revenue, and there are others known as rate of return ratios, which compare the various levels of profits to the investment that has been made. So, let us look at first the profit margin ratios. Before I get into that, I would like to also just revisit and see at what levels of profits that we can talk about. So, usually we have net sales, of which you will then reduce cost of production or cost of goods sold and arrive at what is known as gross profit. From here you will reduce all other operating expenses like administrative expenses, selling expenses, etc., and arrive at what is known as profit before depreciation, interest, tax and amortization. As I said, depreciation is the figure that we do for fixed assets, amortization is for assets of intangible nature, fixed assets but of intangible nature. So, once that has been arrived at, we add any non-operating income, income that has come from other than operations, plus we also reduce the depreciation and amortization to arrive at what is called as profit before interest and tax. So, profit before interest and tax is a very important figure, which gives us at the operating level, purely from the company's operations, what has been the profit that has been generated. Here at the PBIT level, the differentiation is not made as to where the funds have come from. Are these the shareholders' funds that have been put into the company and the assets have been created out of that, or is it long-term liabilities or short-term loans that have been taken, or long-term loans have been taken and put in? It says that overall the assets have been put in. On those assets, by using those assets, profit before interest and tax has been generated. It does not differentiate how much of those assets were funded from shareholder funds, how much has come from other sources of funds which are in the nature of borrowings. The effect of borrowings comes in moment we reduce the interest amount from the profit before interest and taxes to arrive at what is known as profit before taxes, and thereafter the tax amount as would be judged or calculated based on the legal provisions provided therefore will be arrived at. So, the interest will flow to the lenders, the tax will flow to the government, and then we arrive at what is known as profit after tax, which is what is available to the shareholders, of which when dividend is paid out, it actually flows to the shareholders, and balance of this profit after tax which is retained goes to the owners funds and is retained in the company itself. So, these are the various levels at which the profits can be looked at from. So, once we have understood this, let us move on to the actual understanding of the ratios through an example of a company. Let us call it some example company limited, where we have the sales figure of all in lakhs 1120, operating cost of 1008, a PBIT, that is profit before interest and taxes, of 112, an interest outgo of 20, a profit before tax of 92, a tax of 32, a PAT, that is profit after tax, of 60, out of which dividend is paid is 24 and the retained earnings is 36. The balance sheet looks something like this, where the owners funds are 360, long term liabilities or loans are 200, the current liabilities, short term liabilities are 240, the fixed assets, the long term assets are 480 and the current assets are 320, giving us a balance sheet size of 800. So, with this now we move forward to look at the various ratios